Hello everybody, welcome back to The Spot. Today we're going to be talking about inflation, how to beat it, where to position yourself to will define inflation as nothing more than too much money chasing too few goods. In other words, a dollar today will not buy the same value of goods 5 years down the line. And fundamentally, inflation generally measures the average price level of a basket of goods and services within an economy or a market for that matter. And naturally, we have to take time into consideration, so that will either be over a quarter or a year or half a year. Doesn't really matter, different countries report it differently. There are many reasons why inflation occurs, I must say. The current hike in inflation in Namibia, South Africa, basically the rest of the world, could be attributed mainly to supply shocks, I would say, which were caused by our pandemic, and also very high commodity prices. And another very important factor to consider is an increase in money supply. Like I said before, one of my favorite economists, Mr. Milton Friedman, stood very strongly behind the idea that if you pump more money into a society, you will definitely experience inflation, and it should be controlled and bridled and taken into consideration, which I must say a lot of economists have forgotten, or at least it seems that way on the offset.
Our unemployment started to rise. There was a strong tendency by government to say, we've got to do something about this. We have to print more money. We have to spend more money. We have to stimulate the economy, the result of which has been to create an increased quantity of money that in the first instance has had some favorable effects on employment, but only temporarily, only so long as you could fool the people. And then, when people got on to what was going on, it came out in the form of inflation.
To make it more practical and make it make sense, I guess, let's assume an example. Let's assume 5 apples, I would say, in a market, and $5 circulating within this market, right? And that would give you a market price of $1 an apple. And now let's make it interesting. Let's say for whatever reason, money supply increases to $10. In other words, you have $10 chasing these 5 apples. What you're going to have is you'll have more money chasing the same number of apples, and it will allow whoever's selling these apples to sell them at a higher price. Why? Because more people want the apple. So what is the big deal, you may ask? I would say it's a very big deal, because if you're talking about investments, or anybody looking to invest into any type of commodity, stock, bond, money market instrument, you have to understand the main reason why they invest, and that's very closely tied to the idea of inflation. The main reason why individuals invest is because they're willing to sacrifice current earnings in order to spend these earnings in the future. Therefore, improving, or at the very least maintaining, your purchasing power over time is of paramount importance. On one hand, you have inflation eroding purchasing power, and on the other, you have investors maintaining or improving your purchasing power. So just to put it all into perspective, both emerging market countries and developed market countries are experiencing very high inflation rates currently. We just saw the US inflation rate released at 8.5%, marking its highest rate since 1981. To put that into perspective, in 2021, global equities only returned you 32.3%, global bonds 3.5%, and global cash or money market instruments 7.9%. As you can see, clearly only equities could have given you a return that beats inflation. So it's also very important to note that this 32.3% does come with higher risk, which is basically shown as volatility in academia, and not everybody can stomach that. So the main question would then be, what do you want to invest in? And I have some options for you. I would look at balanced funds and absolute return offerings. Both of these diversify through all asset classes in order to reduce your risk. However, more importantly, I'd say looking at an absolute return fund, they usually minimize volatility and target a benchmark, which is most probably going to be your NCPI or your inflation rate plus 4%. A balanced fund offering, however, is completely different. Even though it does diversify through risk, it has a lot more volatility. And the reason for that is because as a balanced fund manager, what you will do is you're going to try and maximize returns within every single asset class you're invested into. That's it from me today, and I wish you luck in the markets. Friendly reminder, this is not financial advice.